I think the polls are certainly helping because they're pushing us towards stimulus. And I think the reality is no matter who wins, we're going to see stimulus. We're going to see more quote-unquote Band-Aid stimulus like we're seeing where they're trying to make people whole. But the market's starting to price in that we're going to see infrastructure stimulus. We're going to see real spending. That is going to drop a lot more bonds into the bond market. It's already been having some trouble digesting bonds for the past month in the Treasury market. So I think you see the 10-year go to at least 1%, maybe 1.25%.
I'm looking, Peter, at the failure of two yield rallies since March. In the land of point and figure, it's called a double pole high top. It's really an ugly thing. We go up in yield and then we go down. And then we go up in yield and we go down again. What does that signal to you?
I think that we've kind of hit the limits of where we can get into terms of lower yields, so that's another reason higher yields. Also, when we had that stock market volatility recently and we are down on stocks, Treasuries barely budged. Yet another negative sign that it's not going to take much to push yields higher. And then finally, I know the MOVE index, which is an index that really looks at implied volatility in the Treasury market. I know it's a little bit wonky, but it's been very, very low, telling me that people haven't been hedging any sort of interest rate risk. So again, another reason I think we're susceptible to a fairly rapid move to 1 to 1.25% on the 10-year.
Peter, that sounds like a lot given the stasis we've seen in the bond market recently. Will that get the Fed's attention? I
don't think so. I think above 1% they start paying attention, and then they maybe start doing things to ensure that we don't get above 1.25. But I do think if you look at the Fed's messaging for the past month or two, they would not be unhappy to see slightly higher yields and a steeper curve, right? I think the Fed has done a much, much better job than the ECB trying to ensure that banks can make some money, right? We are not going to negative yields. I hate negative yields. I think they're the worst thing possible for the economy. So we're not going to get negative yields. I think the Fed actually wants to see a steeper yield curve. And bizarrely enough, it gets very, very circular, but they talk about inflation expectations. That's a calculation from that anyway, so it suits their agenda.
Well, Peter, tell that to the Cleveland Fed. Loretta Mester out yesterday saying, quote, I can imagine wanting to shift to longer-term treasuries as we did during the Great Recession. How do you frame that one?
I think they're going to be very careful not to let it get above 1.25%. So as we start seeing higher yields or moderately higher yields, I think first the Fed will step up buying more treasuries. Then we'll go back hearing a little bit more about yield curve control. And I think we are stuck in this world. We potentially see real negative yields in the U.S., very negative. And that's one reason I remain bearish on the dollar is any inflation which would normally express itself in higher yields is going to be tamped down by the Fed. And that money is going to have to find itself somewhere else. So it's going to express itself in dollar weakness. So inflation is going to be dollar weakness, not higher yields because of the Fed.
Does it matter to you, Peter, as a market guy, that the economists are partitioning inflation among goods and services? Goods, inflation, maybe. Service sector looks like substantial disinflation. Does that stuff matter to you?
It does a little bit, but I think over the long term, we will see an equalization. I do think if we get this infrastructure spending for the first time in a long, long time, we might see some real competition to hire mid-level type employees, people who can manage plants, people who can manage production facilities, and that could actually create wage inflation, which has been really lacking for the last 10 years.
So given the fact that you do think that bonds will sell off, do you think that it is inconsistent for equities to continue to rally in tandem, or do you think that they will continue their rush upward based on this extra support fiscally as well as an improving economy with the end of the pandemic?
One thing I'll say, and it's probably going to sound crazy, but I actually like dividend stocks. And dividend stocks would normally do poorly as yields are rising. But dividend stocks did not respond at all for the past 2 months to low yields. So I think you're going to see a little bit of a normalization, almost what I'm calling a reversal trade. I would have called it a reopening trade a couple months ago, but we've moved so far beyond that. I think it's a reversal trade. I do think big tech is particularly susceptible. Depending on who wins, they may be a target for paying a lot of the bills. So I'd be a little bit more nervous there. I continue to like the performance that we've seen in reopening. I really like the fact that the Russell 2000's been doing well of late. So I think we could see a real strong, smaller company, domestic-focused rally for the next 2 months as this spending comes
Peter,
online.
let's separate these issues out because we're starting to conflate two different issues, I think. There are events that squeeze positions and there are events that drive durable change. Now, the thing that people are worried about going into November is that we don't have a result. The thing that squeezes positions is that we do have one. That's the somebody. The who That is what drives durable change. Now, if somebody wins, i.e. Biden, you get a Democratic sweep, that will squeeze positions. I would argue the other side as well. If you've got a red wave, that would squeeze positions too. But what drives durable change is, that's the person, the policy. Are we conflating the two issues at the moment?
I think a little bit, but I think when you really look beyond the messaging, what's going to be most important to me is, will we get fiscal stimulus? Will we get infrastructure spending? Will we try and rebuild the manufacturing base? And to me, the messaging from both sides is actually very similar. So if I think about what's going to be the most important next year is, do we drive fiscal stimulus? I think the answer is yes, regardless of who wins. How we pay for it might shift a little bit, but that's kind of why I'm very optimistic. And I suspect that at the end of 2021, we will have a better job situation in the U.S. than we had at the start of 2020.